Hello everyone, Richard and David here. It's time for another Ask the Broker.
That's right.
Today's topic is going to be, we have all kind of indicators out there, charts, this, that show us which way everything is going. But what we need answered today is, there's this certain chart out there that's like the Treasury bond versus the mortgage rates, and that seems to be an important one out there. What exactly is important about that, and what's causing the high rates?
Yeah, I want to kind of get into why we think interest rates are so high at the moment. And here's an excellent chart. We're going to go through a couple charts, but the first one I want to show you here is kind of explains what normally takes place and why it's a little bit higher this summer of 2023. Mortgage rates, if you didn't know, they follow the 10-year Treasury yield. You can find the yield out on Wall Street. And today that's right around 4%. So this chart's showing 4.12%. And usually there's a spread or a difference on that lenders will charge. And historically, that spread is 1.72. That over the last 41 years, the average spread's 1.72. And so if that was the case today, rates would be just under 6%. That's a pretty great rate.
I'll take that.
Well, because of a lot of economic uncertainty, maybe a recession, not a recession, higher inflation, what's inflation going to do? Well, the spread lately has been around 3%. So that has caused mortgage rates to be in the 7s.
Ow.
So that's one explanation of why interest rates are typically higher. So let's take a look at now. Here is the chart for the last 50 years. The blue line is the 10-year Treasury yield. And as you can see, the orange is the 30-year fixed rate mortgage. And it tends to follow along with the Treasury yield. The average spread, there it is, of 1.72%. And just because of all the economic uncertainty, we've seen the rates shoot up to over 7%.
So question, they say the inflation rate's going down and going down pretty fast. Mm-hmm. Is that one of the indicators, here we go, another indicator, that will help bring this gap closer and get our mortgage rates down?
Yeah, it should. It should. Once we get better clarification on the inflation data, as that tends to go down, mortgage rates should follow. And I have one more chart for you guys indicating that. So there's been 4 times in the last 50 years where the spread has been above 3%. It did it in 1980, mid-1980s. We did it back in, 2008-9, where the spread increased and rates increased, but quickly, after inflation came down, the rates quickly came down following that. So as you can see, the peaks here on the chart, they reached that point, and then once inflation came down, mortgage rates also came down. So what are experts forecasting rates to do moving into 2024? Let's take a look at that next. So here are the mortgage rate projections from Fannie Mae, MBA, NAR. They've all given their projections moving forward from the fourth quarter of 2023 all the way through the third quarter of 2024. Yeah. And if you look at the far right column, it's the average of all 3 of their projections. And it starts off at 6.2%, 2.7% to 6% roughly, just under 6. And they're projecting by the third quarter of 2024 to be 5.73%. You alluded to inflation has started to fall, so they are projecting mortgage rates will fall as well going into next year.
Excellent. Well, I'll take that definitely, and I'm sure all you buyers out there will take this too. So looks like it's coming. Looks like they're going to start easing down.
Yeah, so what will happen, in my opinion, when rates fall to these levels, under 6%, there's going to be a lot more activity, more buyers that will want to come to the market. There's buyers and pendings and sales overall have been really low this year, so I think there's a lot of pent-up demand. And there's a lot of demand for people wanting to sell and buy a new house, but they don't want to give up a 3% rate to go to 7%.
Right.
There's a lot of buyers waiting on the fence, waiting for rates to fall. So this is going to unlock a lot of activity. A lot of activity is going to happen when rates fall. And when buyers are in the market, it's going to cause prices to rise.
Yeah, realtors store up your buyers because they're going to start coming out when they see these rates coming down, and hopefully that'll also cause a few more listings to come out and might head back toward a normal market if we know what that is.
All right. So yeah, if you're considering buying a home in the near future, and rates do fall down to this mid, to upper 6% range, again, home prices will start to climb once again. So even though if you can swallow the higher rates for a little bit of this short period of time, now would be a great time to take advantage of the prices that we have, because they will go up.
Yeah, prices of housing will go up. Which one do you want, the lower interest rate and the higher price on the house, or a little bit lower price on the house and maybe pay the higher interest rate?
Yeah.
That's up to you.
Well, hopefully this helps. If you guys had any thoughts or comments on any of this data, let us know in the comments below. We'd love to hear from you and get your opinion. So thanks for sharing your thoughts, your ideas with us, and we'll see you on the next Ask the Broker Show.